All right, welcome back to the Elias Macko Show. Now, there's such a big part of Canadian investing, dividend stocks. Just think about the big corporations in this country. Telecoms, Bell. By the way, Bell owns this station. Rogers, TELUS, big telecoms. Videotron Québécois, I should say. You got all the banks, RBC, CIBC. You name it, right? You got all the bank stocks. And then oil, right? Think about the Enbridges of the world. For many Canadians, think about your retirement funds and all that kind of stuff. Big Canadian companies, they're dividend stocks. It has been a rough past year for dividend stocks. Those who have, really stuck by dividend stocks for a lot of good reasons have had a rough year. So let's find out a little bit more about this. Richard Lapointe is with us. He's senior portfolio manager at CIBC Wood Gundy. Richard, welcome back to the show.
Hey, good morning.
And Richard, I'm so happy to talk to you because, and I would say rightfully so, you've been advocating, the gospel of dividend stocks in this country, but there's no denying this year has been a rocky one. What's your take on what's going on here?
It's been horrible. Look, dividend stocks by their nature are what we call interest sensitives, right? Mm-hmm. So an interest sensitive means that when interest rates are down, they go up. They're the exact inverse relation to the interest rates of the day. So why have they been so powerful over the last 15 years? Well, we've been watching interest rates go down steadily for years and years and years. However, along comes this nasty disease called COVID. Mm-hmm. We shut down the economies. We pump enormous liquidity into the financial system to prevent it from seizing. We send out checks to everyone under the sun to make sure they don't panic. We print oodles and oodles of money, and we cause inflation. Start by wage inflation, and then we drive it into price inflation. This price inflation and wage inflation can't be permitted to stay around for too long, so we raise up interest rates. And of course, when rates go up, these dividend-paying stocks that had taken such a wonderful advantage when rates were down, well, they go the exact opposite. Mm-hmm. They falter. So Bell didn't drop from 70 to 50. You mentioned Bell, the owner of your station, because things are going particularly poorly at Bell. That's not what happened. The reason it fell is because it is extremely sensitive to rising rates, and that's what we're having right now. So all the banks, all the telcos, all the pipelines, it's hard.
Now, Richard, here's the interesting thing, right? So as a dividend stock goes down, right, if the dividend remains the same, you're now paying less money for what is a higher dividend, right? So I'll take the Bell example simply because I'm an employee here, so I'm under that stock plan, right? So I'm automatically buying some Bell stock every month. Right now the dividend is 7.5%.
Right.
That's incredible, but at the same time, I'm looking at the stock price. So what do you do as a dividend investor? How do you what should the strategy be?
Here's something I like to tell Canadians, because we always have, I had a very serious talk with a dear friend of mine today and a client. He was down and out. He was upset. Oh, my God, look at how much we've faltered. This is our biggest problem as investors. We get extremely negative when it's time to buy, and we get extremely positive when it's time to sell. Right? So we're always buying into strength and selling into weakness. This is a wonderful opportunity for purchase. Mm-hmm. You mentioned Bell. I can put Enbridge on the table. I could put Bank of Nova Scotia. I could put the Royal Bank. I could put TELUS on the table, your competitor. I can put any number of high-quality companies that pay big dividends and who have faltered. But if you look at them over 30 years, my God, the money you would have made through all these ups and downs, and there have been some ugly ones, was staggering. So yeah, you're buying now. If you're listening to me, you're buying now.
And that would be your advice to investors. We're with Richard Lapointe, a senior portfolio manager at CIBC Wood Gundy. Your advice would be, hey, right, look at those yields you're getting. Now's the time. But is there any risk, Richard, that these companies will then cut their dividend?
Yeah, sure there is. Of course there is. Yeah, because Bell, one of Bell's problems is it does have a fair chunk of debt. And all that debt that's maturing in the next year or two is going to be reset at a much higher rate. So their profits will be less, their cash flow will be less, and there is a chance, not that they've ever done it, or at least not that I remember, that they can cut the dividend. Now, I will tell you one thing. That risk exists with any common equity you buy. But once again, this is the opportunity we're looking for. Because as much as I'm looking at interest rates that have gone up recently, I also see inflation mitigating. From last year to this year, inflation was 8 or 9% last year. I do believe it's near the 3 or 4% now. So as it mitigates, and as the economy feels the pain of those rising rates, it slows, and then rates start to fall again. And therein lies the rub.
Yeah.
The upside from those dividend stocks at that point would be substantial.
Richard, I got an email from Tangerine. I have a Tangerine account. I probably opened it up 20 years ago or something. So I've got this Tangerine savings account. They sent me an email yesterday, and they're like, Elias, any deposits between now and it's February or March of next year, any deposits, 6% interest. So, I mean, I'm looking at that and say, and, there's zero risk. There's zero risk on a savings account, if I'm putting that money in. What do you say to that, Richard, with what's happening?
I say that I would say to you that although that sounds extremely appealing, you're also losing money. So let me explain to you how you are.
Yeah, tell me.
Okay? So 6% comes in. Great, fantastic. But you live in Canada, and Canada is the home of high taxation. Canada particularly likes to tax interest, right? So when you have no risk, that's where federal and provincial come at you hard. So the taxation in Quebec, the high rate is 52% on that interest. So 6 becomes 2.9 real quick. You do not cover inflation at 2.9. See, the thing about risk-free money is you can only make the after-tax return not a penny more. Yeah. If I buy Bell at 50, I make 7 and change. That's a dividend, so I'm taxed at a much better rate. But here's the issue. That Bell stock could go up. We always think during these bad times that all stocks do or go down. No. That stock can go from 50 back to 70. Now, wait a second. Now we're talking a different kettle of fish.
Now you're cooking with gas.
Yes. The biggest risk is inflation.
Yeah.
Inflation is lethal to taxable interest. That's why equity investors over time have done extremely well, because they've been able to outpace inflation, whereas interest investors very rarely do.
Richard, listen, we have to leave it there. It's always a delightful discussion and makes me think. I appreciate your time.
My great pleasure.
Richard Lapointe is Senior Portfolio Manager over at CIBC Wood Gundy.